So let's talk about Brazil's stock market. Is it a massive, once-in-a-generation bargain, or is it a really dangerous trap? I mean, prices are at historic lows, and that's the big question every global investor is asking right now. So let's dive in and break it down.
All this buzz, this mix of incredible curiosity and honestly extreme caution, it really all boils down to just one single, really striking number. 6.7. That's it. That's the number at the very heart of this whole story. What is it? Well, it's the forward price-to-earnings ratio for Brazil's main stock index. Now, in simple terms, that's just a way to measure how cheap the market is compared to its expected profits. And let me tell you, 6.7, that is incredibly cheap. Okay, so just to put that 6.7 number into perspective for you, it is startlingly low. I mean, we're talking about a 20, maybe even 30% discount compared to Brazil's own historical average, and even compared to its peers in other emerging markets. Seriously, on paper, you just don't see Brazilian stocks this cheap very often. All right, so to really figure out why the market is so cheap, here's how we're going to tackle it. We'll start by looking for a hidden value trap. Then we'll get into a smart playbook for investors. After that, we'll map out the market sectors to see what's what. And finally, we'll wrap it all up by weighing what we're calling the Brazil bet. Okay, so what's the catch, right? Prices this low, they just don't happen for no reason. The market is basically screaming that there are some major risks hiding just beneath the surface. And that brings us to a really, really important idea every investor needs to understand. And that idea is something called a value trap. You've probably heard of it. It's when something looks like a total steal, it feels like a bargain, but it's actually a trap. Why? Because there are some deep, fundamental problems, structural issues, profits that are tanking, that actually explain why the price is so low. So the billion-dollar question is Brazil a value trap? So what are these big risks we're talking about? Well, the analysis really points to three main headwinds that are baked into that super low valuation. You've got ongoing worries about government spending. You've got these punishingly high interest rates at home, and of course, a good dose of political uncertainty.
And all this creates this really weird dynamic. It's like a tug of war for capital. See, on one side of the rope, you've got local Brazilian investors yanking their money out of stocks and putting it into super safe, high-yield government bonds. That's draining the market. But on the other side, you have foreign smart money circling like sharks, really tempted by those rock-bottom prices. It's a classic standoff.
So, with all these risks on the table, how does a smart investor even begin to approach this market without falling into that trap? Well, it's definitely not about just jumping in blindly. It's all about having a really clear defensive game plan. Okay, so the playbook that the analysis lays out is basically built on two main pillars. Step one, you have to focus like a laser on high dividend stocks. And step two, you want to overweight companies that are exporters. We're talking about the businesses that earn their money in US dollars, which gives them a natural shield if the Brazilian currency gets weaker. But here's the thing, just chasing dividends in Brazil right now is tricky. There's this massive dividend hurdle you have to clear. Think about it. If you can get a 6 or 7% real return from a super safe government bond, a stock's dividend has to be way, way better to make the extra risk worthwhile. We're talking sustainable double-digit yields. Anything less than that, it's just not going to cut it. All right, so let's get practical. Where on earth do you even find these kinds of companies, the ones with high dividends that earn in dollars? Well, applying this strategy means you can't just buy anything. You have to be super selective about which parts of the market you're looking at. Okay, so here's the 30,000-foot view. The game plan is to overweight the really defensive sectors. So think utilities, they have super stable cash flow. Then you've got commodities, which are a natural hedge against a weakening currency. And believe it or not, insurers can actually do really well when interest rates are high. Now, on the flip side, you want to underweight areas like cyclical retail. Why? Because they just get absolutely crushed when it's expensive for consumers to borrow money. And just to make this a bit more real, we're talking about companies like the utility giant Electrobras, or maybe a global exporter like Suzano in the paper industry, or even a high-paying insurance firm like BB Seguridade. See, these are the types of businesses that really fit that defensive profile we're looking for. And look, knowing what to buy is only half the battle. It's just as important to know what to avoid.
And the playbook is crystal clear on this. You've got to steer clear of the sectors that are most vulnerable to those high interest rates, especially things like cyclical retail. Basically, any company that relies heavily on Brazilian consumers spending money they've borrowed, while they're in a really tough spot right now.
All right, let's pull all these threads together. When you step back and look at the whole picture, the incredibly deep discount, the very real risks, and these specific defensive plays, you start to realize something. This isn't just a straightforward investment. It's a calculated bet. So, what's the big takeaway from all this? This is absolutely not a market where you can just buy an index fund, close your eyes, and hope for the best. No way. The key here is all about careful, deliberate stock picking. It's about hunting for those high-quality, resilient companies that can actually thrive, even if the rest of the economy is just treading water. There's a line from the analysis that just sums this up perfectly. It says, "The Brazil risk is real, but with the right strategy, the Brazil reward is also achievable." And that's it, right there. The risks aren't some kind of illusion. They're very real. But for investors who are willing to do the hard work, the potential reward is just as real. And that really brings us to the final question, the one you have to answer for yourself. Now that we've unpacked the deep discount, the danger of the value trap, and the playbook for how to navigate it, is the potential reward in Brazil actually worth the calculated risk? The answer, it seems, depends entirely on your strategy